Hello and welcome to From the Steel Trenches. This is the second episode. I want to begin by thanking those who have watched the first. The response suggests there is an appetite for a serious, experience-based discussion on steel. This is reason enough to continue. Today, I want to do two things. First, briefly outline the environment in which the steel industry enters 2026. Second, examine four developments from December which taken together offer important signals about where the industry is headed. Much of this builds on analysis I have shared earlier on LinkedIn. This format allows for a more considered discussion. The steel industry today is no longer dealing with short-term disruptions. Deglobalization is not cyclical. Trade is becoming regional. Policy is no longer peripheral. This is the operating environment. 2026 does not appear to be a year that will reward expansion for its own sake. It's more likely to reward discipline. Scale by itself will not be sufficient. Cost control, regional positioning, and execution will matter far more. Let's look at the developments in December. First, China and green steel. China already leads in electric vehicles and renewables. What is now evident is that it intends to establish a similar position in green steel. In Zhangjiang, in Guangdong province, the world's first million-ton near-zero carbon steel line is now operational. This is not a pilot project, it is industrial scale. For an industry responsible for over 8% of global carbon emissions, this development is significant. Green steel will not be defined by declarations or targets. It will be defined by who builds first and who scales fastest. Once again, China has moved early. Then there's China's steel export licensing. This is a second signal from China, quieter but equally important and also deserves attention. China has introduced export licensing for steel. This should not be diminished as an administrative measure. It reflects an intention to curb exports, manage supply more deliberately, and reduce trade frictions with importing regions. For years, excess Chinese exports have been a persistent pressure point in a global steel market. Export licensing suggests a shift away from volume-driven behavior towards control. More broadly, it underlines a wider trend. Policy is increasingly being used as a market instrument. Then look at South Korea and the collapsing steel demand. This is an important signal as well. It points to a very different direction. What happens when parking lots become storage yards for steel? This is not efficiency, it is excess inventory. Dongguk Steel has halted operations at its Incheon rebar plant for the first time in over 70 years. This facility has an annual capacity of approximately 2.2 million tons and supplies core construction demand. This is not supply side disruption, it is a demand side failure. Even after utilization was reduced to between 50 and 60%, warehouses remained full. Continued production would only have depressed prices further and locked in further losses. When steel makers shut down, capital intensive assets that they are, it is rarely a short-term decision. It points to structural weakness. steel is a leading economic indicator. When rebar stops moving, construction, infrastructure, and industrial confidence typically follow. Whether this is a leading or lagging signal can be debated, but what is not in doubt is that the system reacted late. Yet another interesting development, which was in early December, was Simandou, and the first vessel carrying 200,000 tons of high-grade iron ore that departed Guinea. It marked the first shipment from the Simandou project. It's a single vessel, but it represents something larger to come. For the first time, China has a direct high-grade iron ore supply line from West Africa, supported by ownership in the mine, a newly constructed 600-kilometer railway, and a purpose-built deep-sea port. Those familiar with iron ore mining, steel trade, or logistics will appreciate the scale of coordination and capital required to bring such a system into operation. It is early, but over time, this could materially alter global iron ore sourcing patterns. Let's draw the threads together. Taken together, these developments point to a clear pattern. China is scaling green steel. China is exercising greater control over exports. Demand destruction is becoming visible in many countries. And upstream supply is being secured with long-term intent. This is not an industry preparing for rapid expansion. It is an industry adjusting to control, positioning, and endurance. That is why 2026 is likely to reward discipline far more than ambition. I'm not offering certainty. Steel has a long history of confounding confident predictions. But these signals are real, and they deserve careful attention. If you agree or disagree with this reading, I would be interested to hear your perspective. And if you find this discussion useful, subscribing helps the channel develop a steady, thoughtful audience. Thank you for watching. I'll see you next time. From the steel trenches, Danish Elias signing off.